Well, hi, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, your host, and it is Saturday evening, about 9:30, and we're looking at a chart of the S&P 500. And one of the things you'll notice is that we're getting pretty close to where I had drawn this little circle. In fact, we're right on the left edge of it, so next week will be right in the middle of it. And I think that's going to be about it for this upward pattern. We've gotten a little bit more out of it. Which we said before that it possibly could go higher. I mean, it's possible this whole pattern is not even correct. I mean, that's also possible. But that's the pattern we're operating under right now. We're operating under the fact that a fourth wave completion will end down here in some sort of wave E, and then we'll rally another time in intermediate degree wave 5 to end this whole rally. If we go back and look at kind of the big picture, you can kind of see the 1, A, B, C, 2 flat. This is a flat. And then 3 all the way up to here. Now, there's a smaller 1, 2, 3, 4, 5 that made 3, okay? But we're looking at this larger degree trend, and why don't we just draw it here? Probably should have had this on here for before. But I can draw it real quick here. Again, we got a wave 2 flat, and this whole thing is 3, as we mentioned here. 4 will end somewhere down in here, and then we'll have a wave 5 to complete this pattern. Now, if you look at it on log scale, wave 2 and wave 4 are more proportional looking. Take it off log scale, it looks like wave 1 is much smaller. It is in terms of real terms, but in terms of percentages, it's about the same. So this pattern makes sense. Normally you can connect, when we get ready to project wave 5, what we'll do is when wave 4 is over, we'll connect this low right here in wave 2 to the low in wave 4, and that'll give us the projection of the upper channel, which, by the way, is probably going to be shorter. It's probably going to be below the wave 3 here somewhere. That's typically what happens, but who knows? We're not sure, so we'll have to wait and see where this terminates. But I think if you look at if we go back and look at all data on the SPX, now let's put it on log scale. Now we can see, 1 here, ABC 2 flat. All this is 3, all this is 4, and all this is 5. So we got a pretty, symmetrically shaped wave 5. Wave 4 looking pattern. At a minimum, you get a retracement to the wave 4 low, which is this area around 600. It's going to be a pretty deep sell-off, given that we're at 3,000. The last time we had a deep sell-off like that, we were at 1,400 or so, 1,500, down to the 666 area. So this is going to be much deeper, much larger sell-off. And if we zoom in and we just try to estimate, see if we can estimate how big that sell-off might be. It's purely speculative purposes at this time, but sometimes that's fun to do. So let's go ahead and do that. So let's say wave 4 ends right in here, and we project a wave 5, I don't know, up to here somewhere around. It's probably not going to be that high. Probably more like right here. What was that? Let's say 3,500. So if we take 3,500, if we go from 3,500, which is right about there. Oops. Sorry about that. 3,500 is right about there. And I can't seem to draw a line for some reason. Oh, there we go. Now I'm on the line tool. So from here down to about here, that is 85%. Now, the previous fourth wave of wave 3 is right here. It's the 87 low. And a lot of this stuff I've been reading in Elliott Wave says that because this was a 90% sell-off back here in 1929, that we should have another 90% sell-off, which should take us maybe down into this area, which is pretty crazy, I know. If you look at that, that's a 94% retracement, right on the 87 low. We're looking at about 90, right at 94%. So that's a pretty deep sell-off, and obviously it's going to create a lot of pain. You know, when you start talking about things like this, I mean, people just go, "That's just not possible." I mean, what could be going on in the United States that happens? And well, if you read Elliott Wave and you read Social Theory of Economics or Social Theory of Finance, STF, apparently, social mood will just be bad. Everybody will be down on the U.S., down on prospects, which is hard to believe, but that's what things are looking like. Now, it won't go straight down there. We'll probably have a pretty deep sell-off into, this mid 1500 area, a rally, and then, another sell-off down into these lows. And I don't know, it's going to be crazy. So the best thing to do, it's always hard to tell other people what to do or make suggestions, but I would just say pick a place where you're not going to lose any more money and say, I'm out. That's where I'm out. And I think that's probably the best way to go. All right, let's look at some of these other markets. Let's look at volatility from last week. Volatility came down again, which we might expect since the market was up. Now we're down here in these low areas around 12.5. And what we've shown is that when we do come down into that area, we don't stay for very long. So, then we get some sort of spike. So look for that to happen in the next week or two. And I don't know, we'll go from there. All right, let's look at the 10-year Treasury. We talked about, let's get off this all data and get on a 5-year chart. We talked about last week that let me zoom in like this. We talked last week that this could be the low, and so now that we have a low and we have a close above the high is right there of this low week. This is likely to have ended the downtrend. So, if you're gonna go long rates, you're gonna trade rates. What you want to do is, when this is gonna pull up, when it pulls back to a higher low. Okay, so right here, higher low. That looks like a 4. So make that a higher low. Then you want to enter somewhere right in here, and trade it up. So you can see that rates have been very choppy. This next move up should look more like this move right here, except bigger. Usually 2.5 times bigger. So if you kind of do a Fibonacci retracement from here and you go to here, the 2.5% is somewhere up here. Let's see if I can get that on the screen. Sometimes it's hard to. So see, the 2.5% is up here around 45 or so. So we're talking about rates at 4.5%. So not you know, not too crazy. Not it wasn't that long ago that we had rates at 4.5%. So rates are going to normalize and probably catch the Fed off guard. Hopefully, that's what I'm hoping, and that it brings some sort of credibility crisis to the Fed. That's what I'm hoping. So we can see this is the 13-week Treasury. This is what this is where the Fed might end up screwing up. These rates might pull back a little bit again, and then take off from there. So look for that to happen. And then they may lower rates as this pulls back, thinking that rates are lower. But if you look at the 10-year, the 10-year is already taken off. So it's what's likely to happen is the spread on rates is going to widen, and that's particularly difficult for financial institutions because they arbitrage those types of spreads. They borrow money short term and loan money long term. So when those spreads widen, it makes things a little bit difficult for them. Let's look at some of these countries. We've been looking at Germany, Japan, and the UK. We've had this protracted downtrend. Maybe there's a flat happening here. Maybe we get a pullback into this. This is Germany, by the way. Maybe we get a pullback off of the low of this pivot here and then rally on out. Let's look at Japan. Japan just still looks like it's in a general pullback. Probably wants to go here, make a low below this pivot, and then maybe rally. The UK. Let's see, are we on the UK? Yep. Looks much like the other one. That same thing here. Maybe we pull back. So in case you're not seeing that, this is very similar between Germany and the UK. Maybe we pull back here. There's a pivot right here. So maybe we pull back here and then rally out. Something like that. Okay. That's all we want to look at there. Let me go over to the TOS charts. And right now we're looking at oil. You can see the oils right here, CL, crude light. And, what it looks like to me is we got this big, kind of A, B, C pattern. And, this could just be a huge 4. If this is A, B up into this area, or maybe B here. So 1, A, B, C, 2, and then, so this is 1, 2, this is all 3, 4. Now it has to stay below this area right here, this yellow box that I have here, this rectangle. Oil has to stay below that in order for this to be legit. A, B, C, with C being a 1, 2, 3, 4, and then a 5. So this forecast, if you want to call it a forecast, and the caveat there is that this could be totally wrong, but I think you have to have some idea of what you think the market's going to do, if you're going to trade it or invest in it. And so what I think's happening here is we have this huge sideways pattern that's going to last a long time. I was going to see if I could pull up some longer term data. Let me just see if I can get a let's add let's see, max available, intraday, daily. Let's look at week and hit add and OK, and then go up here and see if we can get. See, I don't see. Oh, there's max right there. Okay, so that did not do anything. I'm on the max apparently. So anyway, I was going to try to get some room out here to kind of show you what this might look like. Right now, I'm expecting oil to start rolling over here shortly, hopefully shortly, and then come on down into this area. and then that would be A, B, C. So we still got a long way for oil to trade sideways in this fourth wave. At least that's the forecast I'm operating under at this time. So, all right, let's look at gold. Here's a long-term chart of gold. See, here's the run-up from 1999 in the bull market, and we've got a correction going on here, an A, B, C, which we're showing our target is right in this area. Now, let me zoom in here a little bit. What I've got showing here on the chart, and I didn't really, I guess I'm off on the timing. I had this running out a little further, but I think it still could get there. But essentially, you know, oil, I guess, pull back a little bit and then start rallying up into this you know, I've got this yellow box here, but it could go a little higher. It could go as high as this 1450 area. But oil, gold still has room to run, and you know, I think it's certainly tradable here up into that 1500 area. Silver, I think, is probably going to pop too. It's just going to move a lot farther, a lot faster, which is, you know, the ratio between gold and silver is really high right now, meaning silver's underpriced relative to gold. So it could actually move very quickly up to this place, and gold could only move, you know, $100 or $200, and it still would be pretty typical of gold and silver. Sometimes silver can run quite a bit more than gold. So, you know, who knows? Maybe silver runs up in here pretty far before we get a sell off. I'm showing around $25. It's certainly very possible. All right, let's look at the euro. The euro is something I've been talking about quite a bit here. We've had this strange looking choppy market. Then we had this area where we took off pretty big. And if we measure this, if we just get out Senior Fibonacci and just measure this from high to low, you can see here that we've got about a, whoops, I did that backwards. I always do that wrong. High to low projects. We want, did I do low to high or high to low? Now I can't even remember. Let's try it this way. From here to here. Okay, so see, we've pulled back 62% right in here. This is the 62% area. And then we've rallied off. So we've got this kind of a large one here. Potentially it looks like a one. And then you got this kind of screwball, kind of crazy pullback, but right into a 62% area. So, you know, what we could be looking at here is, say, a 1, and then a 2 here. Of course, we know it comes after 2, right? 3. So 3, talking about, you know, back to these highs here. So we got a pretty big move coming in 3. So I think anywhere in here is a good place for the euro. But again, this is your own money. You do with it what you want to do. And don't let me talk you into something. Don't let anybody else talk you into anything either. Learn how to, you know, evaluate some of this stuff yourself. Pick your stops. And I mean, the nice thing about entering right here is you can enter here and you put a stop below these lows here. Because who knows, this could roll all the way back here and make a new low. And if that does, then we have to reevaluate what our pattern is here. But right now we're operating on the idea that this formation, this pullback, all this is the pullback, and we're saying it's complete. Now, if you come back and you go a little further, can we go any further? I guess we really can't. But let's just look. Let's just go from here to here on Fibonacci and see what the pullback is. I think that's going to be interesting. So let's go here to the high, and you can see this was 62% right here. So we went below 62%, chopped around, and then rallied out. So, and then if you look at this pullback, sometimes I like to do this. Just, I mean, it doesn't really mean anything. I mean, you can't really say, oh, well, this is this is it. This is because I see this, or because so we had more than 62% pullback to here. We had this takeout, and then a 62% pullback here. You know, if you enter here and put a stop below here, then to me that makes a lot of sense from a reward to risk standpoint. Okay, so let's see, US dollar CAD, you know, British pound US dollar, same kind of deal. We've got a high, and we got this kind of an A, B, C pullback. We got a rally, a pretty deep pullback. Let's just measure this from high to low with Fibonacci. So here to here. So see, on this one we got a 78% pullback. So you know, here's a little bit different looking. I mean, this could be more of a more of the pullback. But I would say once we get some closes, I would say above this area right here. So let's just draw that. Drawing tools. Let's have a line. You know, once you get above this area right here, you can kind of see there's a channel here. Once we break out of this channel to the upside, man, I think I might look at the British pound US dollar as well. Okay. All right. Last week, one of the things I want to point out is last week I pulled up a really long-term chart of the ES, and we had a DP sell signal on here, and that since it wasn't a failed trade, so to speak. But what happened is the DP signal got here. Well, once we gapped up, you know, you would have never gotten put in the trade. But once we gapped up, then the DP sell signal went away. Which, you know, you could have said, well, I'm going to wait on that anyway because I haven't quite, you know, hit my upper barrier. You know, what I did is I got it touching there. I have it touching here. And the reality is it wasn't touching here yet, and it's still not touching here. Okay, it's still not touching there. So, but maybe we'll get a touch this week. I think I said last week, you know, we could very well get something that kind of looks like this, where you get a run up kind of outside of it, and then it turns around and comes back. And to me, these are great entries because if the next entry looks like that, I mean, you can at least trade that down to here, at least down to this 2,700. That's 300 points on the S&P 500, and you know, and who knows, you could trade to there and then hold it and see if it's gonna, you know, if it kind of chops sideways. Sometimes what it'll do is it'll make its way down to something like this, chop sideways, maybe make a little rally, and then totally sell off like this. So, you know, those are great reward to risk entries. There's some products out there, in case you're not familiar with them. Well, I tell you what, let's do this. Let's go to the internet. And let's put in inverse S&P 500 ETFs. So here they are here. So you get the XPU, which is a minus 3x. Now I would stay away from the multiple, the minus 3. I trade the SDS sometimes, which is a minus 2. That's weird. I'm not familiar with this PSQ. Let's look at it and see what Investopedia says. So let's see, ProShares SH. That's the one I was thinking. This is probably the highest. See, look at the average volume, almost 3 million shares a day. That's what you want to stick with. Here's the SDS, almost 4 million shares a day. So SH, SDS. Then you start multiplying. There's some double and triple things here. I would stick with the SH and the SDS, though, just because just more liquid traded. They're more liquid. Let's look at the SH and just see this how it's down sloping constantly, even though we got these rallies. That's because they have to use futures to create these, so the expenses are quite high on this. Whereas if you look at the SPY, it tracks the S&P 500 almost perfectly. And that's because they don't have the expenses aren't as high, so they're not constantly taking from the fund. So you just have to be aware of that. Same thing with the DIA. If you want to look at the DIA tracks the Dow perfectly. But when you start getting to the SDS, you see how there's this constant downslope. You have to be a little bit more careful with these instruments because the expenses are higher and they constantly take money from you. So if you hold them for a really long time, eventually they'll take a bunch of money from you. So you might want to avoid those, unless it's just a really short-term trade. So for example, if you wanted to short this here in the next week or two, that's fine, for, like I say, a 3-month trade or something, or even a 6-month trade would be okay. But if it comes down and then rallies higher, you want to sell. Take your loss and sell. You don't want to hold on to that and try to wait for it to turn back over. Alrighty? All right, everybody. I think that is about it. The only thing I was going to show you is that DP sell. It was on this weekly chart. Now it's moved to, I think it's a 120-minute chart. And that's usually what happens is you start seeing sell signals and stuff on shorter time frames. Well, maybe that one. See, these are a couple failed trades here. Maybe let's see if it's 240. Maybe there's not an active DP. Nah, I guess there's not an active DP sell. I thought there was, but there's not. So forget what I said about that. But we are at a place where resistance is just barely overhead. If we zoom in here, it looks like on this chart, it looks like I'm already touching. So the S&P 500 could already be touching, whereas let's see what I don't have it drawn on the SPY. I don't think. No, I don't have it drawn on the SPY. Let's just draw it real quick. So I just want to touch there. See, we're above on the SPY when you plug in these touches. Like so. So anyway, it is what it is. A lot of times the ES will be, hold on, let me pull it up, will be the chart that the market works off of. Heck, I don't have it drawn here either. Let's draw it real quick. So touch there. So see, on the ES, we're not quite touching. So we may have some room to go on the ES. So we could have that kind of a dragonfly doji where the market runs up outside of this and then turn around and immediately sells off, and those are always exciting. That's makes for some exciting trading. So keep an eye out for that. Maybe you buy a little SH or a little SDS, make some money to the downside. I guess that's it, everybody. I just I wouldn't be putting new money to work here. If you're holding old money, that's probably okay, but just have a place where you're going to say, I'm out, Because if you go all the way down to here, I think we already measured that once, but I'll measure it again real quickly. Let's just get a line here. Let's just say we get up to here, and then we go all the way down here, right in the end of the year. Heck, it could be longer. We could go into, let's say, May of next year. Well, that's what is that? That's almost 30% to the downside. So, who wants to lose 30%? Nobody, right? So just pick a spot and protect yourself, protect your assets, and you should be fine. All right, everybody, thanks for coming in this week. We'll talk to you next week. Bye-bye.